Imagine the unbreakable American consumer, the one that's been propping up the global economy since the pandemic and through the trade war, isn't as invincible as we thought. What if this shutdown just isn't a blip, but instead it's exposing the booming economy that perhaps was always just a mirage? Now, why DC bickers, many American households are starting to worry. 17% of everyday folks, just like you and me, are now slamming the brakes on buying homes, cars, and their dreams. And the problem is, for our economy, when the confidence of the American consumer goes, the economy and the markets are next. Now, you're starting to hear the roar of the recession building. The dollar's starting to rally just as I predicted. Stay tuned. I'm going to show you exactly how to navigate this, because right now the U.S. shutdown has dragged on with Republicans and Democrats trading blame. We're now in the 9th day. We have 750,000 federal employees going unpaid and perhaps with no back pay in sight. And right now in New York, we've seen their statewide sentiment. It's absolutely crashing. It's now at the lowest since April. And the odds of getting something done by the government through the weekend, well, there's little to none. And this is a major issue because we're losing $15 billion in GDP each week. Consumers are now losing confidence, and they're finally saying they've hit their breaking point and their spending is about to go with it. Consumer sentiment is cracking amid government shutdown as 17% of Americans delay major purchases. And this is one of the biggest problems we're facing right now. The reason we're not in a recession, although arguably in the early stages of one now, is because U.S. consumers, despite their pessimism, continue to spend. But right now, what we're seeing, 17% of consumers saying, look, they are done. That's roughly 1 in 6 Americans are delaying a major purchase like a home or car because of the federal government shutdown. That's now according to a new Redfin survey. Another 7% are canceling plans outright for major purchases altogether. And the majority of Americans, that's 65%, so the government really doesn't have any impact on their plans, and that's for good reason, because their jobs aren't tied to it. But what we're hearing from the other 35% of Americans is they're seeing an impact on the economy. They're seeing it slow down. And it's not just about the shutdown, it's about the mirage that you see in the stock market that's telling us the economy is booming. And what this is going to have a huge impact on is holiday spending. We're hearing that in other surveys that spending is going to decline, but the problem is we're now starting to see it show up in hirings. And people whose incomes aren't directly dependent on the federal government's budget may be rethinking a major purchase because the shutdown is one more in a long line of events making Americans feel unstable about their finances. And that's exactly what I've been warning about. That's what we've been seeing in the consumer confidence surveys all along, that everyone's starting to believe that, look, things are going to get worse. They haven't yet, but that's the problem. The moment you see the wheels of this economy halt, it's because spending dried up. And that's what we're facing right now. Paychecks continue to shrink relative to inflation. American consumers just have less. But the problem is the economy is slowing on top of it. It's not just the fact that we're losing $15 billion a week during the shutdown. The reality is this is just exposing what I believe has been a mirage this whole time. Let's turn to this chart of the University of Michigan Consumer Sentiment Survey versus average weekly hours of production and non-supervisory employees. That's shown in red. And there's a real key point that I want you to see here. First, it's sentiment that declines. And you can see this going all the way back to 2000. And then what happens? Weekly hours go right alongside it with a lag. And again, you see it going into the financial crisis. Sentiment leads hours. You see it happen right around 2015, 2016. It happens again in 2021, and it's happening now. What we're seeing now is consumers. They've hit their breaking point. They're saying we're done. We're going to cut back on our spending. Now, I want to give you a quick update on that trade we put onto our subscribers from our optimized MES strategy. It went back on September 9th. That trade up now 16.44%. And I want you to see just how easy it is to use our system, because every day we give our subscribers notes. We give them the symbol. We tell them where it was generated from. We tell them when to buy it, what their upside target is, and where to set their initial stop loss levels at. We make it so easy. And I've got some big changes, some big updates coming, and my subscribers are excited about this, and I don't want you to miss out. Now, all you have to do to sign up is grab those links in the description below and use the coupon code for your free 30-day trial. Stay tuned to the end of the show for more information. And this means for a lot of retailers, they're going to cut back on their hiring, as seasonal retail hiring is now set to fall to the lowest level since 2009. And what this is doing is signaling major trouble for the holidays. And if you think about the nearly 2 million Americans on long-term unemployment right now, some seasonal work would be a huge benefit to them. And what about the marginally employed? They could pick up a second job, and that money could get spent into the real economy. But the problem right now is if we don't see a lot of seasonal work come, it's not going to be the boost the economy needs. Challenger Gray and Christmas is projecting retailers may add under 500,000 positions in the final 3 months of 2025, marking the smallest seasonal gain in 16 years and an 8% decline from a year ago period. And for a lot of businesses, it's not about the tariffs or inflation or the government shutdown, although they might say it is. It's really about declining demand on top of the fact they have way too much inventory and their margins, well, they're shrinking. And now the risk is they can't overhire on the holiday season because they've got to keep Wall Street impressed with their numbers or their stock price will come crashing down. And while we could see a late hiring push of holiday sales surprise to the upside, the cautious pace of announcements so far suggests that companies are not betting on a big seasonal surge. This year may be more about doing more with less. And unfortunately, this is the reality that many American households have been dealing with years. They've been stuck doing more with less due to high inflation and the fact that their paychecks haven't kept pace with it. So what did they do? They borrowed a lot of money to get through it, thinking that the economy was going to turn in their favor. The problem is it didn't. So now their debt service costs have gone up. It means they're having to find ways to do more with a whole lot less. And now businesses, they're finding themselves in the same place. They're having to struggle as well. And the problem is, as their bottom line shrinks, it means their payrolls are going to shrink as well. And that's going to have a massive impact, not just on workers here in the US, but all over the world. And Chief Executive Officer Ramon Laguarta said that Pepsi Company is already moving swiftly to reduce costs, which means in a very nice way, we're going to start reducing employees. So you can see as the spending declines, what businesses are going to do is lay off. And the numbers here that Pepsi saw, they weren't that big. A 4% drop in volume in North American food sales was, quote, disappointing. But this is a perfect example. When you're faced with doing more with less, what do? You spend less on the things you don't need. In this case, it had to do with a lot of snacks. And that means Pepsi's going to cut back. And as Americans further cut back because they have no choice, it means businesses are going to cut back more. And you can start to see how this thing starts to spiral out of control. Now, yesterday we talked about how the German industrial base saw a big minus 4.3 month-over-month decline. Of course, what did the experts say? What did the statistics office say? Well, it's just a seasonal issue. And I said, not a chance. If you look at the data, it's not seasonal. But if you look at the American consumer here, and this is why they're saying a big warning to the entire world. Look, we've reached our breaking point. And when we stop spending, not only are we going to lose jobs, but you're going to lose jobs as well. Let's take a look because German exports now, quote, unexpectedly drop as shipments to the U.S. sink. And you know, this is again proof that it's not seasonal, as we see total exports decline 0.5% in August from the previous month, compared to a 0.2% gain predicted by the experts. Again, shipments to the U.S. retreated now for a fifth straight month. So you start to look at U.S. consumers here, and they're saying, look, we're cutting back. Even if it's only 17%, that's still a big number. It's going to have a massive impact, not just on the German manufacturing base. You're going to see it happen in China and other parts of Asia, here in the U.S., all over the world. Because when consumers cut back, again, manufacturing jobs are going to go, and in a big way. But it's not just manufacturing. I think one of the big things consumers here are worried about is when you see a decline in imports, because there's, again, a lot of jobs tied to imports coming into this country. Well, it means domestic jobs are going to go. Let's take a look at the chart of imports and goods and services in blue against the unemployment rate in red. And you can see very clearly as imports slide down and cross that horizontal black line, enter contraction, what happens? The unemployment rate in red rises. And this is what I believe the consumers are seeing. They're seeing demand drop, and they know it means they're going to lose their job. And that's, again, the worst case scenario. At the very least, they're going to see their hours get cut. They're going to find ways to do more with even less, and that's going to impact spending. Because, again, the dollar doesn't go as far as it used to, and when you have fewer of them, well, it means your spending is going to drop. That's going to affect manufacturers, again, all over the world. They're going to have to cut back on their production. Jobs are going to be lost. And now you can see very clear signs why that recession roar is building. It's getting louder with each passing day. It's also why you're starting to see the dollar rally. It's not about the shutdown. It's about the fact that the booming economy, or at least so-called booming economy that everybody said the stock market was validating, is starting to look more and more like a mirage every day. And that's why what we're seeing in the economy right now is not something the stock market is pricing in. And that's why I warned about the dollar the other day, because it's starting to rally. And if it breaks out, it could unwind many popular trades. It could send tech stocks, gold, silver, even crypto crashing. And you think on top of that, the shutdown's pulling $15 billion a week out of the economy at a time when we can ill afford that. What we need to see is consumption rising, spending increases, and companies hiring, and we're not seeing any of that. Now, right now, even though consumers are saying they've reached their breaking point, well, if they come out and spend, well, then we know it's all talk and no action. But the fear right now is if we see any declines in holiday spending, it could be the biggest indicator that we're already headed into a recession. The problem is the dollar's saying we're already there now. Now, what can you do to survive this situation? Well, you can lock in 6 months of cash on a high-yield CD before the Fed cuts rates. And while they may not cut at the next meet, we know they're going to be cutting soon. You want to look at your budget, cut out those non-essentials, look to rotate some of your portfolio into defensive. And how about this? Leveling up your skills, because if you end up on the unemployment line, you need to stand out against your competition. Remember, even in the midst of a storm, you can still thrive and profit. Now, if you're wondering how we came up with this amazing trade on SMH and so many other trades like it, it's because I've done something no one else has done. And I have optimized my trading system on a per security basis. Now, everyone else says you don't need to do that, but I want you to see exactly why. Now, this is from our Metre strategy. Right now, it's already on its second generation, but you can see total return. This is a back test on SPY. Up 71%, beating buy and hold. Win rate 66% on 69 trades, and a max drawdown of 7.5%. And that is amazing. Now let's compare this to an unoptimized strategy. This is run by my buddy Jay Bravo, who says, well, you can sign up for it, but you need to sign up for a bunch of other stuff because it doesn't work on its own. And he's right. Look at this. Total return 51%, missing buy and hold. Win rate a paltry 51% on half the number of trades, and the same max drawdown. So you can see the big difference here. Under his system, one size fits all, and you got to sit in front of your trading screen and look at other indicators. With mine, you just need to press the buy button and put your stop loss level on. Because what is our Metre strategy? Well, right now, it combines 10 professional trading strategies, soon 11. Now it's designed with a target hold period of 10 days, perfectly optimized for swing trading. It generates hundreds of signals a year, and on top of that, you can see the win rates are impressive. Now, how do you get signed up for this? Well, you got to sign up for one of my reports. Now, maybe you like to trade momentum indicators like the RSI, things like the MACD. Well, we pair those technical indicators with a trend. We call that Momentum Timer Pro. But maybe you like to trade machine positioning, and this is our flagship report. Because when we hit, it hits big, because this report is unlike any other trading system out there. We look to position you ahead of a big machine buying and then get you out before they sell. Now, when you sign up, you get the daily report for either one of them, but you don't even need to look at it because I give you in the notes all the tradable signals. Plus, right now, you get those Metre strategy trades at no additional charge. You get my opinion on the best trades. We give you risk control levels, a full tracking of all open trades and returns, a weekly update, and again, here's the best part. You get a 30-day trial. So whether you're new to trading or maybe you want to compare us to your existing system, all you got to do, grab those links in the description below and be sure to use a coupon code for your free 30-day trial. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.